Hello everyone, good afternoon. I am C. Sunil Kumar Khandal, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICI. It's my pleasure to be a moderator for the 53rd webinar on AS 15 audit aspects in employee benefits, accounting and tax audit, clause 36, 37, 38 and 39. In a short while, we will start this webinar. First, I would like to appraise you about CP committee. The profession of chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession at the forefront. Today, our profession has acquired an indispensable position in the business and economy. ICI continuously aims at developing knowledge edge so that the members stand out the expectation of the society. To achieve the objective, the CP committee of ICI has been continuously striving for perfection, integrity, and knowledge, which make the word chartered accountant synonymous with excellence in service. In this direction, CP committee has always been proactive to the emerging needs of its members, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing CP programs and providing adequate opportunities. The program for today is as follows. We have two sessions of 1 hour each, and topics are key audit aspect in employee benefit accounting AS 15 and tax audit clause 36, 37, 38, and 39. Our eminent speaker will talk about mention two emerging areas of professional interest. Today, our CP committee chairman Satish sir with us. Satish sir is from Jaipur, and uh, in short, if I will say, Satish sir is serving as the chairman of the continuing professional education CP committee of the ICI. In addition to this role, he is also the chairman of UDIN director and vice chairman of the committee for members in practice CMP for the current team. He previously served as council member of ICI from 2019 to 2022. He is a renowned speaker and author, specialization in income tax assessment, such as surveys and professional development topics like goal setting and career planning. So now I would like request to Satish sir, please join
Thank
us.
you. Thank you, Sunil. Thanks a lot.
Thanks, sir.
And my brother, C. Karthikeya Kandoi, from my own state, but now residing at Mumbai, but doing very great in the field of actuary. And my another friend, Gaurav Rawatji, he is also from Jaipur. And both the speakers are going to take up two very important topics today. Karthikeya is going to take the AS 15. I think he is expert in that particular area. Whenever the employee benefits are concerned, how to make the provisions and how to deal all these things. And Gaurav is going to take some clauses on the tax audit. My brother in Sunil Khandal, who is moderating today's session. Secretary of the committee, very dynamic and very proactive, Ginni Goyalji, Team CP, Team Tech, and my dear friends who are attending this webinar in such a large number. I am aware that the days are of the tax audit and other audits and other statutory compliances, and it is very tough for the members to spare time. But despite all these busyness, they are sparing time to learn something new, to get the value addition, which is encouraging for the CP committee also. So welcome, my dear friends, each one of you, and thank you from the deepest core of my heart for attending the webinars. Friends, I will speak few things about the CP, few things about the UDIN, and some things about the CMP. And one important thing I want to bring at the very outset is the WOFA 2.0. Friends, your institute is going to organize this year World Forum of Accountants at Noida on 30th January, 31st January, and 1st February. These 3 days are going to be Very, very important, my dear friend, because we are targeting 25,000 chartered accountants are present there at a one very big auditorium that is. And apart from this, you will have the opportunity to connect with all those chartered accountants to see and to admire that what is happening in the world in the field of taxation, accounting, auditing, and what are the emerging opportunities for the profession throughout the world. So don't forget to attend this particular WOFA 2.0, which is going to be held at Noida in my own region on 30th, 31st, and 1st of two dates of the January and one day of the February 2026. Apart from this, friends, I would like to bring in your kind notice that at CP, we are holding as much as webinars, seminars, conferences, national conferences, residential refresher courses, workshops, just to ensure that each and every chartered accountant member of the institute get updated on the changes. This month we rolled out some series of the provisions of the tax audit, accounting standards, and standard auditing, just to ensure that this is the audit month, my dear friends, and we wanted to ensure that whatever value addition we can make by organizing these webinars. So we decided it to, and definitely we are getting success in this our endeavor. Friends, this year we are targeting that CP program reaches to the last member who is residing in the remotest corner of the country, for which we are forming new chapters, new circles, and new groups of the CP. And I request each one of you, if your place is not having any branch, CP chapter, CP circle, or CP group, so according to the norms and regulations, please encourage your members to form the chapter or the group so you can also hold your own CP program. I just want to tell you that if any central committee organizes a webinar and any chapter of the country or any group of the country calls their members at one place and physically and charges the requisite fees, then by viewing that webinar, the member can get the structured learning hours. So it is a wonderful initiation of the CP committee or ICI, which can be benefited, which can give benefit to all of our members who are residing in the small cities or small towns. Apart from this, friends, we are also focusing on the quality. We have made 10, 12 changes this year. And after the approval of the council, I would request Gindiji kindly notify all those changes to our branches or the chapters or to general members that they are being aware about our changes, what we have brought. But the most important thing which we want to bring this year in the CPE committee, friends, and that may be liked or not liked, but this is the need of the our friends. What we are going to do that we are going to give the credit of CP hours on the real time attendance basis. We are working on the new tech portal of the CP committee with the help of TCS, where we, with the help of technology, we will ensure that the credit is allotted to the member only on real time attendance. So if it happens true, if it so I think there would be delivery of quality of the topics of the discussions, and all the members will be benefited by that particular technological initiation. So this is something about the CP, my dear friends. Apart from CP, I just promised you to that I would spare some time for UDIN also, where I am the convener of the UDIN directorate. Friends, in the UDIN, we have brought few things, few changes this year. Number one, now the member from 1/4/26 onwards would not be in position to generate UDIN for 61st of the tax audit. Secondly, now the member would be in position to know the name of succeeding auditor in case the auditor does not pay the previous auditor, or there are technical issues which the previous auditor want to communicate with the succeeding auditor. So by just dropping a mail to the UDIN directorate, he or she will be in position to know the name of the succeeding auditor. Third thing, which I think which has been made effective, is the auditor's opinion in this year in the Udin format, and that is a wonderful thing which will help the institute in making the research or in making the data available in case of need. First thing I want to say that all those data of the audit opinion shall remain secret. Those data will not be visible to anybody other than the chartered accountant itself. Number one. Number two, there is some confusion while complying those data. So my dear friends, we are holding one webinar of Udin today evening 4 to 5. Kindly don't forget to attend that particular webinar. But for the members who are not in position to attend that webinar, just to brief that, the first question asked is that whether this auditee needs the opinion, applicable opinion is there or not. So there yes or no. So in tax audit case, there will be yes, because a no has been kept only for the purpose that if auditor want to generate due for a certificate where there is no need of opinion, then you have to fill the no. Otherwise, in case of you are framing an opinion on any financial statement, then there will be yes. And in case of tax audit, we do two type of audits. Number one is the audit of the financial statements. Number two, the audit of the 3CD. So in case of your observations are in case of 3CD, you need not to go ahead. But if your opinion or if your observations or if your qualifications or disclaimer is in regard to financial statement and you are filling the clause 3 sub clause A of form number 3CB, then you will have to definitely say that particular choose the qualification, disclaimer or the adverse opinion. Otherwise, you can go with the unmodified opinion. So this is something about that particular compliance of the UDIN form which audit in regards to auditor's opinion. So with these friends, I would like to tell you something about the CMP, Committee for Members in Practice. Friends, we have brought two, three things for the benefit of our members. Number one is the unsecured loan from HDFC Bank at the rate of 10.60% per annum, reducing rate. No collateral security is required, and term loan is available up to rupees 50 lakhs according to the ITR or other conditions of the bank. But very good rates, competitive rates by looking the other market, other players in the market. Second thing, we have also brought the one credit card by the AU Bank, where the member having the credit card will get the benefit of airport lounges, and also the member will be entitled for a 25% discount for 1 year while paying the fees, renewal fees of the ICI. Suppose I am a member of the ICI, I pay the suppose 8,000 rupees per annum. I will get a discount of rupee 2,000 whenever I pay to the ICI my fees, and that discount will come to me directly. So this is something which we have done already, duly approved by the committee, but we are coming up with some term life insurance policy and some audit tools, some other softwares. We are working on that. And I think within a month of 30, 40 days, you will see some other initiatives of the CMP. So with this friend, there are several things to me to speak, but I know that this is the time of my dear friend Karthikey Kandoi, who has come from Mumbai in this webinar by leaving his office, and he's also always, I can say, ready to spare time for the knowledge giving to our members. So I don't want to come in between Karthikeya and you people, and request Karthikeya to please deliberate what are the provisions of AS 15 and how the members can comply with all these provisions in detail. So thank you very much, Ginni ji, Sunil, and my dear brother Gaurav, who will take some provisions of the tax audit also. So thank you. Thanks a lot. Over to Sunil.
Thanks, Satish sir. Name of succeeding auditor will definitely help other auditors. Actually, I am also facing problem last year in 2 3 cases, and airport launch card will also help all CAs at the time of audit. Now, before inviting CA Karthikeya Kandoji, who is first speaker for today, I want to tell about brief profile of Sir. CA Karthikeya Kandoji is having experience, decade of experience in actuarial and accounting consultancy, specializing in actuarial accounting and ESOP advisory. He served as a Central Council member of the ICI and is a special invitee to the Accounting Standard Board of ICI 2023-25. He is also a member of the Insurance Accounting Committee of the Internal Actual Association and faculty for various ICI courses on NDAS and employee benefits. He is one of the youngest profession in India to qualify as an actuary and has also advised over 800 organizations on actual valuation and ESOP. Now, I want to invite Karthikeya Kandoji. Sir,
Thank you very much, Sunil ji, for warm
thanks,
welcome.
sir.
And thank you to Satish sir for giving this opportunity and always blessing us by his wisdom of words, and appreciate the effort of institute, specifically in the CMP, because CMP is one uh, part of our organization in the institute which is helping all the chartered accountants, all the students and staff of the institute. So it is very well commendable work of the CMP. Now coming up to our today's topic on the employee benefits. So employee benefit is one of the area which is very important from the organizations, because it covers various labor laws, then accounting of the same, how accounting is to be done of the employee benefits, what are the important aspects which as an auditor we need to take care, then as a top tax auditor what are the important aspects we need to take care. So all of these things we will be covering in our deliberation. So as a disclaimer, these views presented are my own views and does not represent the views of Institute of Actuaries of India or Institute of Chartered Accountants of India. Before I move on the specific to the topic, a brief background about the Actuaries Institute, which I represent as a council member as well. So Actuaries Institute is registered under the Act of the Parliament. It is a statutory body, and Actuaries mainly works in the area of risk and where a lot of use of statistics, mathematics, etc. Mainly actuaries are working in the field of insurance, where the use of appointed actuary, consultant actuary is there for life insurance, general insurance, and health insurance. In employee benefits, the actuaries are working very extensively in the area of like gratuity, leave encashment, pension valuations, employee stock design, etc. So this is a brief background about what actuaries do. Although a lot of things are there, but this is just a brief glimpse I thought to cover. In our today's agenda on the employee benefits, we are going to cover on the why this accounting standard 15 is very important. What are the regulatory aspects, different assumptions involved in the valuation, some calculation, how the assumptions will impact the liability we'll discuss, and very important aspect, audit checkpoints and things to be taken care as a auditor, both statutory auditor and the tax auditor. We will discuss about this. So if we talk about importance of employee benefits accounting standard, this board of ICAI, which highlights various non-compliances in different accounting standards. So if we see AS 15 on employee benefits is one of the standard having highest non-compliance after the AS 3 on cash flow. So we need to see that in our organization where we are auditing or we are the taking a charge as a finance management in our organizations, these non-compliances are not there. We will discuss how to deal with these non-compliances so they are not repeated in your organization. If we talk same kind of non-compliance in Ind AS era, then there are again lot of non-compliance in Ind AS 19 on employee benefits, but there are more non-compliance in the newer Ind AS. So this is one reason why this standard is again very important from the accounting side. to ensure that all these non-compliances are not observed in our financial statements. Now coming to the AS 15 on employee benefits as well as the Ind AS 19 on employee benefits, they have divided the employee benefits and the standard in 4 buckets. So first one is the short-term employee benefits. As the name suggests, short-term employee benefits. So these are the employee benefits which are paid over the short period to the employees. For example, they can be paid within 12 months from the reporting date. Let's say regular salary payment which we are making, or any director remuneration we are making payment, or company having any leave policy which do not allow carry forward of leave beyond 12 months from reporting date. So all these type of benefits are covered under short-term employee benefits. Another example of short-term employee benefit is the regular bonus plan. For example, let's say based on the financial period of 24 to 25, company plans to give a bonus in the month of May 25. So this is also short-term employee benefit, and we have to account for under AS 15. Now question can come, when we need to account for the expense. So the standard says we have to account for the expense when the service is rendered and not when the payment is done, because we have to follow accrual principle. And since this is a short-term benefit payment, we have to account for in the financial year 24-25 itself when service is rendered based on the best estimate of the payout. For short-term employee benefits, there is no requirement of actuarial valuation. There is no need of any discounting because these benefits are paid in a very short run. It do not goes beyond 12 months from reporting date. So you can say uncertainty of payout is very less. There is more certainty towards the estimation of amount, and it is paid sooner than later. So that's why there is no discounting involved in the short-term employee benefits. Moving on to the next category, which is post-employment benefit, it is very important, and having lot of uncertainties in terms of benefit amount. The standard have bifurcated this post-employment benefits again in 2 parts. First one is the defined benefit plan, and second one is defined contribution plan. So what happens in the defined benefit plan? The benefit is defined like what will be final benefit to the employee, but ultimate cost of the employer is not certain. That will depend how long employee will stay in the organization, when employee will leave the organization, what will be salary at the time of payment of that benefit, etc. So there is a lot of uncertainty on the amount of benefit and the timing of the benefit. So this type of benefit is called as a defined benefit plan, and due to all these uncertainties, the accounting standard requires that these benefits needs to be done accounting in the financial statement as per the actuarial valuation by following a specific method called projected unit credit method. We will discuss that in detail, but this is one type of benefit which requires actuarial valuation, use of lot of assumptions like discount rate, salary growth rate, attrition rate, etc. The next category is the defined contribution plan. So defined contribution plan where the outflow which is going from the company, you can say contribution from the company is very well defined. For example, provident fund. Every month company contributes 12% to the EPFO. So that contribution is defined for every year's service. For example, this year's service, you know that you have to pay 12%. There is no future outflow required from the company. So cost of the company is very well certain. So this is called as a defined contribution plan, and there is no requirement of any actuarial valuation in defined contribution. The accounting is again very simple for defined contribution. Whatever is the cost of the financial year on an accrual basis that we need to provide for, and if any outstanding payable on 31st March, that will be recorded as an outstanding liability. Coming to the third very important classification criteria, other long-term employee benefits. So these are the benefits which are payable to the employee in a longer period after 12 months from balance sheet date. but they are paid before end of employment, because if it is paid after end of employment, it will come under post-employment plan. But if it is paid between 12 months from reporting date to the end of employment, in between somewhere, they are called as a other long-term employee benefits. For example, let's say a company wants to pay a bonus, but this bonus will be paid out in a 3 years time period. So this is called as a other long-term benefit. Similarly, company can come up with a scheme that employee completing 5 years, they get say gold coin of 2 gram. Employees completing 10 year service, they get 10 gram gold coin, etc. So this kind of plan is also covered as a other long-term employee benefit, and accounting has to be done as per the actuarial valuation in the financial statements. Similarly, there can be policy of leave carry forward, like companies carry forwarding the leave to the next financial year. That leave can be encashable leave or non-encashable leave, but for both type of leave, we need to make the provision in the financial statements. The next category is the termination benefit. Termination benefit is mainly paid whenever company terminates some employees or provides some VRS scheme. So that time company may be paying some lump sum amount of termination benefit or a series of payment, etc. So if we talk about the actuarial valuation specifically in the accounting standard 15 as well as in DAS 19, it is required for defined benefit plans and other long-term plan. These benefits require actuarial valuation. Short-term benefit and defined contribution plan do not require actuarial valuation, and accounting is also quite simple given provided under AS 15 and in DAS 19. Now let us discuss about the accounting standard 15 applicability to the companies, because as we all are aware that there are a lot of accounting standards from AS1 to AS29, and out of these accounting standards, various accounting standards have relaxation for different category of the companies as per the size of company, etc. So as per the recent definition which is applicable from 2021, the criteria of SMC and non-SMC is defined. If any company is having turnover less than 250 crore, they are called as a small and medium company. Turnover beyond 250 crore, they are called as a non-small and medium company. You can say big company. So for small and medium company, few relaxations are done in the different accounting standards. So if we talk about AS 15, what is the relaxation given to small and medium company as compared to the large company? So there is one important relaxation in case of AS 15 is that for small and medium company, for the benefits like post-employment defined benefit plan like gratuity and pension, etc., they are relaxed from the disclosure requirements. So they do not need to give the detailed disclosures, but they need to ensure that provision in the financial statement is done as per the actuarial valuation PUCM method only. So for small and medium company, turnover less than 250 crore, they need to ensure provision of gratuity or leave encashment or pension, if any. It has to be done as per actuarial valuation. If it is not done, then it is non-compliance of AS 15. Whereas if it is a non-small and medium company like a large company, so they will have to make the provision as well as the disclosure in notes to account also. So the relaxation is there in terms of the disclosure only and not from the provision. There are few other relaxations also in AS 15 for small and medium company that relates to the short-term employee benefit obligation, that if company have a short-term leave policy which is non-encashable, so for that kind of policy, they do not require to make any provision for short-term non-encashable leave. But if it is a long-term non-encashable leave, that has to be provided for in books of accounts. We would also welcome questions. You can put your questions on Q&A. We will take towards the end of this deliberation. So in nutshell, for small and medium companies and large companies, all needs to make the provision as per actuarial valuation. This is a glimpse under Ind AS 19. So in case of Ind AS 19, there are no exemptions to small and medium companies. So if it is Ind AS applicable, it is applicable in full. So if we talk about the accounting provision, it has to be done under AS 15 as well as Ind AS 19. Only relaxation is for the disclosure in case of AS 15. So I hope it is very well clear. And this is one of the biggest accounting error in the financial statements. Now coming to very important aspect of the regulatory benefit, which is the gratuity. Like gratuity is applicable in India to all the companies with 10 or more employees. And there is a criteria that benefit is paid to employee if 5 years of service is completed. And there is a limit on gratuity of 20 lakhs. So this limit is under the Gratuity Act. Then it is under Income Tax Act. So for example, as per the gratuity formula 15 by 26 into years of service and basic salary, if the formula comes to let's say 30 lakhs amount, then statutory liability of company is only 20 lakhs, not 30 lakhs. So company very well can pay 20 lakhs and discharge their obligation. At the same time, Act provides in the section 4 subsection 5 of Gratuity Act that employer and employee can have a separate arrangement for a beneficial scheme. So there are few companies who provide beneficial scheme, but otherwise statutory liability is only 20 lakhs limit of gratuity. So again, this is one of the misconception in the uh, uh, various professionals sometimes, so that needs to be taken care. Coming to the accounting aspect, as we discussed, this provision in financial statement is mandatory for all size of companies, whether it is small company, medium company, large company. All companies needs to make the provision as per actuarial valuation, even if the service is less than 5 years, because this is also again one of the accounting error, that company says that we are a startup company, last 3 years only, no employee have more than 5 years of service. So why do we make a provision? So these kind of companies also needs to make a provision as per AS 15 para 70 and Ind AS 19 para 72. So that needs to be taken care as an auditor, that such provision is made in the financial statements as per the actuarial valuation. Coming to the taxation, which is again very important, whatever provision which we are making in the books of accounts for gratuity, this provision is disallowed. The provision is allowed only on a payment basis under section 40A7, and if company is having a approved gratuity fund, then such contribution to approved gratuity fund is also allowed as a expenditure. But this approved gratuity fund, it is given under section 36(1)(5). This we need to read with the part C of schedule 4 and guidance note on tax audit 37.2 para, which provides that tax auditor and company, they need to ensure that this group gratuity fund has to be a approved fund. It should not be just a LIC policy or ABC insurance company policy. There has to be trust. Trust needs to be approved from the Principal Commissioner Income Tax, and every year there is a requirement to file the ITR of such trust. This is the requirement of the Income Tax Department to file the ITR for such approved trust funds. Although income of the trust fund is exempt, but we need to file ITR. So this is again very important point which we auditors needs to take care of. Another important point is under Rule 103 of Income Tax Rule, there is a limit of 8.33% contribution that a company can get the tax benefit only at the rate of 8.33% of the annual salary, which translates to 1 month basic salary. Beyond that, it cannot claim the benefit. So company cannot do that 2-3 years, they do not contribute anything, then suddenly they contribute very high amount. So this kind of limit is placed in income tax rule. Coming to the audit aspect, Standard on Auditing 620 requires the use of actuarial valuers work for these defined benefit obligation liabilities, and at the same time SA 620 provides for certain checks to be done by auditor also. That also we will discuss. Then there are these non-compliances found by the Financial Reporting Review Board and Quality Review Board of ICI. So which again stress on the matter of these provisions to be followed appropriately. Another important employee benefit which is very well common in the industry across India is the leave. So if we talk about the statutory requirement of leave, it is governed by the Factories Act and Shop Establishment Act. And these act provides for how many leave company need to give in a year. For example, for every 20-day worked, they give 1 day leave, etc. This kind of some provision is there in some of the Shop Act or Factories Act. Further, this act provides for how many leave is allowed to be carried forward, whether they will be encashable or not. So all these basic questions are answered in the Shop Establishment Act. Now, if we talk about some of the example, I have given a list in the below note over here, like Rajasthan Shop Act, Factories Act, they have a limit of 30 days carry forward, that employees can carry forward the leave up to 30 days. Similarly, Maharashtra, Karnataka, Delhi Shop Act have a limit of 45 days. Gujarat have a 63 days limit, etc. And all these act provides that these leave are encashable at the time of exit. So if any company is not following this, then they may be potentially violating these acts. So that needs to be again taken care by the auditor, and suitable call needs to be taken by the company to comply this labor law. Coming to the accounting aspect, as per accounting standard, this type of leave which is allowed to carry forward in the future longer run, they are provided for in the financials as per the actuarial valuation. And in the taxation, this provision is again disallowed, but this is allowed only on the payment to employee basis. There is no benefit of group leave policy with any insurance company, like there is a group gratuity plan under section 3615. If any company is doing funding of leave with any insurance company, then it is just a investment and not a tax deductible expenditure. So that is again we need to take care, because it has been observed that some companies claim and they try to claim the contribution to leave policy also, but that is not allowed under Income Tax Act. Then there is SA 620, which again stress upon the requirement of actuarial work, and Financial Reporting Review Board report also stress upon the requirement of provisions as per PUCM actuarial valuation method. As we discussed, leave policy can be short-term leave, long-term leave, based on the carry forward beyond 12 months or less than 12 months. It can be encashable leave or non-encashable leave. For all these type of policies, provision has to be there in books of accounts, but actuarial valuation is required only for the long-term leave, which is carry forwarding beyond 12 months. So they can be encashable leave or non-encashable leave. Their provision has to be done as per actuarial valuation. If leave is not allowed to carry forward, then there's no future obligation. So for that kind of leave, no provision is required, because there is no future obligation, so no provision. So I hope it is clear till now. Coming to some of the important actuarial valuation assumptions, I will just touch upon their names. So one important assumption is the discount rate. It is based on the risk-free rate on the government securities. Another important assumption is the salary growth rate and attrition rate. This is very important assumption in actuarial valuation, and auditors also have a duty to ensure assumptions are reasonable. So for example, company have a regular trend of attrition rate of let's say 20-30%, like हर साल 100 में से 20-30 लोग छोड़ के जाते हैं, and for actuarial valuation they keep a assumption of only 2-3-4%. So question is whether that kind of assumption is reasonable or not. So auditor is also responsible as per the requirement of SS 620 to check assumptions are reasonable or not. Similarly, actuaries are also responsible as part of the actuarial practice standard 27. Like auditors have standard on auditing, actuaries have actuarial practice standard. So both of these institutes have put their professional on a requirement that they need to ensure reasonableness of assumptions. So there needs to be tested appropriately. Then coming to some of the important aspects and audit checkpoints. This question comes very frequently whether director should be included or not. They needs to be included as per AS 18 as well as Ind AS 24. Then it may be possible that a company have different benefit scheme than gratuity act. For example, some companies have gratuity formula of 2/3 rather than 15/26. So that needs to be taken care in actuarial valuation. Similarly, assumptions are reasonable. Then for the leave actuarial valuations, there is a concept of leave availment and leave encashment. So leave availment needs to be valued on gross salary and leave encashment needs to be valued as per the company policy on leave encashment, which can be basic salary or gross salary as the case may be. Then these are some of the non-compliances which are found by the Financial Reporting Review Board. Because we discussed there are a lot of non-compliances found by the FRRB. So these are some of those non-compliances, like non-provisioning of gratuity. So this is violation of matching principle, that company has not provided for the expense in books of accounts where service is already rendered. So this needs to be ensured. That there is inadequate disclosure for the post-employment plans. Standard requires disclosure of actuarial valuation assumptions. What is the expense amount that needs to be disclosed, which was not disclosed. Then appropriate disclosure on the use of projected unit credit method and their assumptions, they needs to be disclosed. Actuarial gain loss inappropriately recognized in Ind AS 19 for post-employment plans. Then for long service award or leave benefits which are long-term carry forward, they have found in some cases they have not valued as per actuarial valuation. So these are some of the non-compliances under the AS 15 as well as Ind AS 19. They needs to be taken care. This third one deals with the defined benefit wrongly treated as defined contribution plan. So this is type of a exempt provident fund. So this exempt provident fund, they are having exemption from the EPFO. So this exempt provident fund requires that they need to match the interest as per the EPFO rate. So if actual return is lower than the EPFO rate in the trust, then company need to give the extra money. So this is a kind of additional obligation on the company which requires actuarial valuation because there is an uncertainty in the future lower interest earnings. So this is classified as a defined benefit plan which needs to be accounted for as an actuarial valuation. Now, these are some of the non-compliances found by the Quality Review Board. They have found that in the testing which they have done, that auditor needs to ensure that actually have necessary competence, capability, and objectivity for the work done, and reasonableness of assumptions and method needs to be appropriately checked. So for the first one, auditor can check for the certificate of practice of the actuary. So similar to C Act, in Actuaries Act also only proprietor and partnership firm is allowed to practice, company is not allowed to practice, so that can be checked. Also, in the certificate of practice as given by the Actuaries Institute, they provide for the practice area. So, for example, whether someone is expert in the employee benefits or not, someone is expert in life insurance, general insurance, etc. So, that can be checked by this certificate of practice. Then, for the reasonableness of assumption, one can check the past trend in the company of the actual salary growth rate, actual attrition rate, etc., as we discussed earlier. This is the extract of SA 620, which requires that the auditor needs to ensure that assumptions are appropriately checked, and review or completeness of data is also required. For example, company have 1,000 employees, but data is sent only for 300 employees. So this is auditor needs to check whether the data given to the actuaries cutoff data, it is well fully covered. That has to be ensured. So checking of data, assumption appropriateness, and actuary is expert or not in that specific area. These are the items required to be checked by the actuary. Then they have to rely on the calculation done by the actuary as part of the expert work. This is one of the penalty imposed by the ROC for non-compliance of Accounting Standard 15 provisions, because AS 15 is also one of the accounting standard which needs to be complied as part of the Companies Act compliance. So there can be penalty on the company as well as it can be on the auditor if we do not qualify the financials. Coming to some of the sample audit checkpoints. So one very important checkpoint, it has to be data cutoff that needs to be checked. For example, it has to be 31st March active employee, they need to be considered. It has to be all employees data. It should not be just above 5 years or less than 5 years. It has to be 100% employees working on the balance sheet date. Then if there are employees who left the organization but benefit is outstanding, so such due but not paid liability needs to be accounted for as a provision on 31st March. If employees are transferred from one group to another group, then transfer of liability needs to be recorded. Auditor should check for appropriateness of assumption. Then variance analysis of actuarial gain loss can be done. That will help immensely to the auditors in understanding the reason of why cost is moving high or low as compared to last year. They can discuss with the actuary on the volatility of expenses. Then these are some of the consequences. Obviously, we know that cost of non-compliance will be higher than the cost of compliance. So there can be a lot of consequences. For example, there can be labor law penalty if there is non-payment or non-following of the labor law. Then it is a Companies Act penalty can be applicable to the company if accounting standard is not complied. If as an auditor we do not qualify our report, then it is non-compliance on our part. As a tax auditor, we have a duty to check this income tax approval, and approved gratuity fund should be there because it is required under para 37.2 of guidance note on tax audit. Then in some instances it has been observed that insurance companies like LIC or other insurance companies, they also provide some kind of calculation to the company for the gratuity funding. They are not AS 15 report. So appropriate AS 15 report as per the balance sheet cutoff date has to be obtained by the company appropriately. So this is all in summary on the accounting standard 15 and the Ind AS 19 on employee benefits from the aspect of the accounting, auditing, and the tax audit angle. So thank you very much. We can take the questions from the participants.
आई में डाला है क्या?
Anyone, if having questions, please share with us.
स्टेट टैक्स में करते हैं जो बैलेंस बचा हुआ है ना.
Okay, so one question I can see in our chat that so the question is company is newly established having let's say 2 years of service. So whether this type of company requires the provision of gratuity. So as we discussed earlier, there is para 70 in the AS 15 which requires that although service of the employees may be less than the vesting period, which is 5 years for the gratuity, but still provision is necessary in the books of accounts. And further, accounting standard says that while making this provision in books of account, we have to allow for the suitable attrition rate, and then only proportionate provision needs to be made. For example, if attrition assumption is let's say 20% per annum, and employee is currently having service of only 2 years. So in nutshell, in 3 years, employee can leave the organization with 20% per annum probability. So what is the cumulative probability of employee leaving the service in next 3 years? That needs to be factored in the actuarial valuation, and only the pro rata provision needs to be booked in the financial statement. So I hope this addressed the question. We would
Anyone,
request, yeah, we would
anyone
request
having question?
members.
I think, sir, questions are over.
Okay,
So, thank you very much, sir, for your kind knowledge.
thank you very much.
I think our participant got benefited from your experience. So, and actually very fruitful session. So,
Thank you.
and now I would like to invite our second speaker for today, Gaurav Rao ji. First of all, Gaurav sir,
हाँ सुनील सर.
see, Gaurav sir is having extensive experience in audit, company law, GST, and NDAS. He also holds additional qualification, including the diploma in information system audit, visa, and certification in Indian accounting standard, and is also academically qualified as a CS. Gaurav sir served as a member of the Auditing and Assurance Standard Board of ICI 2023 and 24, and contributed to the various ICI study groups and publications, including the guidance note on bank audits and the implementation guide on reporting on audit trail. So now I would like to invite Gaurav sir for next session. Gaurav sir.
Thank you so much, Sunil sir. I thanks the ICI committee and especially Satish Gupta sir for giving me this opportunity to express my views on a topic which is always very close to everyone who is in day-to-day audit practice, especially for the assurance work, that is tax audit. So tax audit is something like if we say it's a bread butter and a very core to the heart issue of every chartered accountant who is doing the practice work, because this is the one of the oldest work that chartered accountant are doing. I guess in 1991 this tax audit was started. I'm just sharing the PPT also, Sunil sir, just a second.
Yes.
Is it visible, Sunil sir?
Yes. Tax audit under Income Tax Act 1961.
Right,
Yes.
sir. Right. So basically, today's my topic is specific four clauses of the tax audit, that is Form 3CD. But before that, I would like to start with the basic background of what the tax audit is and what are the things that are being taken care while doing the tax audit. So the object of tax audit. So basically, the object of tax audit is three tier compliance, that is ensure compliance with respect to the books of accounts, detecting of the irregularities on regular basis rather than having a time of the assessment. So basic content of tax audit is compliance related and detecting the irregularities that are due to errors, omissions, and discrepancies that are being done at the client or assessee level. And third is the insurance of transparency. Basically, how transparent the professional can make the books of accounts. So the basic objective of tax audit is ensuring compliance, detect the irregularities, and enhancement of the transparency. So if we say what is the meaning of tax audit, then the meaning of tax audit will come out to be a mandatory examination of books of accounts by a chartered accountant to verify the correctness of income deductions, income, and tax compliances under Section 44AB, read with the Rule 6G of the Income Tax Act 1961. So the basic aim is to verify the correctness of income, deduction, and compliance with the law, so that to ensure a proper computation of an income of a particular individual or an entity in a legal manner, which is compliant to the law also and with the regulatory authorities also. And what the auditors do, auditor furnish a report in form 3CA or 3CB as the case may be, with an annexure 3CD for expressing an independent opinion on the accuracy and completeness of the taxpayer's financial statements and statutory compliances. So the basic meaning of tax audit will arrive from this slide. Now, what will be the importance of tax audit? So, importance of tax audit would be preventive in the nature, assurance role, and development role. That is to act as a check against the tax evasion, and misreporting enables early detection of overall errors and irregularities, provide credible third-party assurance to tax authorities that enhance trust and reduce unnecessary litigation at the department's level, and promotes sound financial discipline and better record keeping, so that it encourages voluntary compliance and accurate reporting. So basically, tax audit is type of a preventive check by an independent person who is a chartered accountant of a particular entity or a SSE on behalf of the government to ensure that all the legal tax compliances have been done, and if any irregularity or deviation is there, so that can be checked and corrected at a basic primary level. So from this, what we can conclude is that benefits of tax audit to both the taxpayer and to the government. So to the taxpayer, what the benefits are, it's early detection of errors and rectifying before the filing of ITR, better financial management and internal controls, reduce risk of penalties and prosecution due to non-compliance of some things or some aspects of tax, facilitates easier loan approval from banks because it has a approved or a certified financial statements which states that these are as per the law of the land, and provides clarity on allowable deduction and exemptions. So if any confusion is there to the assessee with respect to what deduction he can claim or what allowances that particular entity can have, so that is also get cleared by way of conducting the tax audit. On the contrary, what the government gets is it ensures accurate tax collection and revenue protection, reduce need for detailed scrutiny assessment. As we say, the number of scrutiny assessment is definitely reducing day by day, at least the percentage, promotes voluntary compliance culture, helps identify tax evasion patterns and trends, and streamline audit and verification processes. So basically, this is the win-win situation for both the parties. Now, the basic section, the section 44AB, that is tax audit. So what it says that every person carrying on business or profession shall, if his total sales, turnover, or gross receipt exceeds the prescribed limit, has to get its account audited by a chartered accountant and furnish report in prescribed form. So legal legislative intent is that section 44EB was introduced to ensure that taxpayer above certain economic threshold maintains proper books and gets them independently verified. This creates a system of check and balances, reducing tax evasion while providing the department the reliable financial data for assessment purposes. And audit report form is that the audit must be conducted by a practicing chartered accountant who certifies compliance, and as said earlier, by way of form 3C or 3CB along with the annexure of 3C. So when does section 44AB apply? Business turnover tax audit is mandatory if total sales, turnover, or gross receipts from the business exceeds 1 crore in the previous year, which has been increased to 10 crores if cash receipts and payments does not exceed 5%. This I will explain in further slides. In case of professional receipts, so basically a professional receipts has been categorically differently dealt by the law. So tax audit applies when gross receipts from the profession exceeds 50 lakhs in the previous year, applies to doctor, lawyer, architect, and other professionals, which has been specifically mentioned in section 44AA. And in addition to this, there is also one section of presumptive taxation, which says 44AD, which I am not dealing basically this time. So as mentioned in last slide, the 5% cash rule of a 10 crore taking benefit. So what is this? It is a 5% test.
Gaurav sir, sorry to disturb you. The slide is not moved.
It's not moving?
Yes, sir.
Okay, just a second.
Yes,
Sir.
it's not moving.
I share again, sir.
Okay.
Okay.
Yes, sir. Now it's visible.
So it's changing also, Sunil sir?
Yes.
Okay. So sorry for this. I was not aware that it's moving. It's just I have taken up these slides.
5% cash rule and 10 crore benefit.
Is it visible, Sunil sir?
Yes.
Yes. Okay. So the 5% rule says that the basic limit of 1 crore will raise to 10 crores if assessee follows this 5% cash rule. So what the 5% cash rule is that the aggregate cash receipts during the year does not exceed 5% of the total receipts, and aggregate cash payments during the year does not exceed 5% of the total payments. So basically, if we check the cash book and the total transaction book, that is bank book and a cash book, and total transaction value of cash and bank in consolidation, if compared to the cash transaction of a receipt side and payment side separately, if except the contra transactions, then if that particular cash transaction on the receipt side is less than the total transaction of the receipt side of bank and cash consolidated, and similarly, the payment side of the cash book is less than 5% for the total payment side of cash and bank transactions. So in that case, this 5% test eligibility would be there. And any assessee who fulfill these two criteria get an exemption of getting its accounts audited up to the turnover of 10 crore rupees. So the condition of 1 crore get replaced by 10 crore if this particular 5% test is fulfilled. The only thing is that it has to be simultaneously met. That is both the expense side or the payment and expense side and receipt side should has to be meet this 5% test at a go. So basically these are penalty no. So second is auditor's role duties and process, that is what the auditor role should be there and what are the duties he should be there. So basically mandated duties of an auditor are that he complies with the section 44 AB. The report that is published by the auditor should be in compliance with the section 44 AB, and it should be followed by a ICA guidance note, that what are the things that have been mentioned in the guidance note should be properly dealt by the auditor. Should use professional skepticism of the transaction while assessing the transaction, getting the legal things in down, and definitely should have a documentary evidence. Don't just accept the document for the face value. The document should be properly, thoroughly checked and should be matched with the transaction. And just as we do the audit for the basic appropriate audit evidence, so it should be accordingly deal in such a manner that documentary evidence is there. And above all, maintain absolute independence. The auditor must completely independent in mind and appearance, avoid relationship or situations that could compromise objectivity and ensure unbiased reporting. Ethical conduct is non-negotiable and it protects integrity of the audit profession. So these are the basic duties. For the purpose of documentation and relevant standards, SA 230 audit documentation should be fulfilled, which states that audit performed, evidence obtained, and conclusion reached. Maintain a robust SA 500.
Gaurav sir, Gaurav sir,
I have messaged him. Looks like he dropped due to the technological.
Gaurav sir,
Sunilji, while Gauravji joins back, can we see some of the Q&A which have also come during the last? Okay, the Gauravji is back.
okay.
Okay, fine. Thank you.
Okay.
Gauravji?
Kartik ji.
Yes, sir. Please take.
Okay, it's visible now.
Yes, sir. Visible.
Okay, internet glitch was there, so वो log out हो गया
Yes,
I
sir.
guess.
Yes,
Yes,
sir.
yeah. So, what will the pre-audit checklist? So, pre-audit checklist will be documents that need to be accepted by the auditor. It should be financial and accounting records, which include the financial balance sheet, P&L, trial balance, detailed general ledger, fixed assets register, and list of the other things, that is debtors, creditors, the loans and advances, unsecured loans and all. Statutory compliances, GSTR 3B, 1 returns, 9 returns, TDS, TCS statements, Forms 26AS, AIS, these all should be there with the client. Business context should be there, and so verifying the expenses part should be there. Vouching of significant payment should be there. The tax compliance with respect to section 40A3 and others should be there. And if there are any provisions or write-off are there, that should also be taken care properly. So various reconciliation should be part of the clause. This GST reconciliation and TDS reconciliation should be there, which should be properly deal with the books of accounts, TDS compliances, and impact assessment should be there. If there is any other auditor, or if someone is doing the branch audit level and you are the consolidating auditor, in that case also reliance at the other auditor should be there, and respective standards which are there in respect to the using the work of another auditor should be properly deal. So now the basic topic, that is clause 36A to 39. 36A because 36 clause has been recently omitted and no such clause now exists. If the 36A clause has been, 36 has to be divided into two clauses, 36A and 36B, that are there. So 36A clause deal with deemed dividend under section 222E. Clause 36B deal with the share buyback disclosure, recently amendment in 2025. Clause 37 deals with the cost audit disclosures requirement. Clause 38 deals with the excise audit disclosures, and clause 39 deals with the service tax status. So basically, these are the four clauses that are being there. These are very small clauses with very limited reporting requirements. We'll discuss these clauses one by one. So firstly, clause 36. So basically clause 36 was the residual clause erstwhile 3CD, which has been recently omitted. Auditor should skip this clause because there is no such clause now available in the utility also. So starting with clause 36A, this clause address deemed dividend provision where payment made by the closely held companies to the shareholder or their associates may be treated as dividend income. So this clause has a specific requirement of reporting if any deemed dividend provisions are triggered in the financial statements. An auditor want to report of the such transaction. Otherwise, in the most of the cases, it will be nil or not applicable. However, if in any entity there is a deemed dividend violation or anything which has been related to section 222 is there, then in this case, it has to be reported here. So key reporting element would be loan or advances transaction, any payment, advance or loan given by the company to shareholder holding substantial interest. So basically any amount by way of loan or transfer in the nature of dividend has been given to the shareholders who are having a substantial interest. This has to be considered whether the same should be needed to be reported here or not. Accumulated profit verification, confirmation that company has sufficient accumulated profits at the time of payment. Commercial substance test is whether transaction have genuine business purpose beyond tax avoidance, and related party disclosure, that is complete details of beneficial ownership and relationship mapping should be there. So critical threshold is that it applies when shareholder holds at least 10% of the voting power and company has accumulated profit. So basically the substantial interest as defined in income tax act is with respect to the 10% of the voting power. And this clause will trigger only if the audit what we are doing is in the profitable. So basically there should be a profitable audit and accumulated profits should be there. Then only this deemed dividend provision would be there. If the company is incurring loss, so in that case, or have accumulated losses, then in that case, section 222 will not be triggered. So auditor responsibility in this case would be to obtain necessary certificates from the assessee regarding shareholding pattern and loan details, verify payment made to the shareholders, cross-verify TDS under section 194 with respect to 26 AS, AIS, and independent explanatory remarks should be there for the purpose of checking the eligibility. Now, clause 36B. So clause 36B has been newly amended, newly addition to the form 3CD. It has been recently amended and this part has been put it out. So the clause says that addressing the shift of buyback taxation following the abolition of section 115 QA. So this buyback taxation has a change in the recent amendment act, due to which this reporting standard has also been changed. So auditor must verify details of share bought back during the previous year, computation of capital gain in shareholders' hand, correct classification as short-term or long-term capital gain, and proper disclosure and return of income by shareholder. This marks a fundamental shift from company level taxation to the shareholder level taxation, requiring meticulous documentation and disclosure. So in the previous, before the amendment of section 115 QA, the taxation of the buyback was dealt by the company's hand. So the company who is doing the buyback has to pay the tax by grossing up the basic things. But the act changes and this shift of taxation burden has been done from the company to the individual person or the person who is receiving this particular buyback transaction remuneration. So now if any such transaction is there where the entity has given the share for the buyback and received some remunerations or amount, then in that case this clause has to be dealt with. Now, clause 37, that is cost audit reporting under this particular form 3CD. So this clause focus on the specific reporting requirement mandated by clause 37 of form 3CD under the Income Tax Act, addressing situation where a cost audit is required or has been conducted. So focus area is reporting requirement related to cost audit status and key findings. Objective is to ensure transparency and proper disclosure when cost audit are conducted under Companies Act or are otherwise ordered by statutory authorities. So basic purpose is that whether the cost audit has been conducted or not. So in this, the responsibility is that the tax auditors duly require regarding clause 37 is one for verification and disclosure and not a re-audit of cost report itself. So basically the audit has to be done by the cost auditor. The only thing is that we have to verify and disclose the clear documentation and facts about the things. So what has to be done? Ascertain from management, confirm with management whether a cost audit was mandated and subsequently conducted for a period under review, obtain the cost audit report and secure a certified copy of complete cost audit report from the assessee for documentation purpose, and note the key findings, that is systematically review and note all material findings focusing on disqualification or specific points of disagreement noted by the cost auditor. The tax auditor must not perform a detailed study of cost audit report. The focus is solely on nothing material qualification or disagreement. That's it. So the basic purpose is to noting of a material qualification and disagreement and not getting the audit again. If a cost audit was legally ordered for a relevant period but not has been finalized by the tax audit report date, specific disclosure protocol must be followed to maintain complete compliance integrity, that is order but not completed. So if the cost audit was mandated but the report is not yet available, the tax auditor must clearly state this fact, explicitly mentioning in the tax audit report that the cost audit report is not available as of the date of this tax audit report. No opinion or incomplete audit should be considered in that case. reporting consideration is that accuracy in reporting requires strict adherence to the relevant accounting period. The tax auditor must ensure that only appropriate documents are included in the compliance review, relevant to current year only. Reporting deadline should be there, and exclude out of scope reports. So reports that are not as per the scope should be definitely avoided or reviewed. Clause 38, excise audit reports. So this clause requires reporting on whether the assessee is required to obtain any excise audit report under central excise rules and its filing status. With the implementation of goods and service tax, that is GST, from July 2017, excise duty has been subsumed. This clause has now been limited applicability and primary applies to only the legal, the pre-legacy cases, and with respect to the specific items that are still out of GST, such as petroleum and alcoholic products, and any other pending excise matter under litigation. If in that cases the audit is being considered, then definitely a reporting requirement would be there. So if we have a broad understanding of what clause 38 is, that code requirement is clause 38 mandates the reporting of any audit conducted in the Excise Act during the relevant financial year as per the overall tax audit report of Form 3CD. Primary object is to confirm and report on the status of any excise audit performed on the assessee's accounts, and relevance of the law is definitely a excise law, since in GST no such audit requirement is there. So key disclosures would be auditor disqualification and identification of disagreement need to be done. So whether the auditor has disqualification of any or identification of the disagreement. So auditor responsibility is verify with management, extract key findings, obtain audit report copy, and no opinion required. That is, only the documentation part has to be taken. No opinion is need to be done in this particular case. Clause 39, that is service tax status. Current status, basically this particular clause is the most redundant one, which is no more required in particular case, because it generally deals with only the service tax cases, which are very few pending now. So basically, auditor must report only if a pending service tax demand or refund related to pre-GST period, that is 1st July 2007, is there. Then only this has to be done. Otherwise, no such requirement would be there in this particular slide. So if we take the summary with respect to what the key takeaways are there for the auditor, is that in case of deemed dividend, the focus should be closely on the closely held companies. In 37, 38, 39, the statutory cross verification should be there with respect to the findings by the various authority or the auditors who have done the audits. And last but not the least, documentation and disclosure should be properly dealt by the auditor doing the tax audit for these particular 4 clauses. So thank you so much for my side. These were the basic introduction and basic things that are being reported in these particular 4 clauses, as these are the very small and very few cases fall in these clauses. Thank you. Thank you from my side.
Thanks, Gaurav sir, for your knowledge and for your valuable time. And anyone else have question, please ask.
I think, sir, no questions are there.
Yes, yes,
Yes, yes.
I also think so. So, Gaurav sir, thank you very much for your kind and valuable time. And I think all our participants got benefited from your knowledge. So now we are ending this session, and thanks to all.